is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Wall Street slides as turmoil at First Republic rekindles fear of a U.S. banking crisis. But U.S. futures rebound after beats at Microsoft and Alphabet reassure investors that this year's tech rally has room to run. The companies outline their visions for AI. Plus, Standard Chartered reports its largest quarterly profit in 9 years as rising interest rates boost its bottom line. We're going to hear more from our interview with the CFO. Now, the markets maybe are faring better in the U.S. than they are in Europe. Europe has to do a little bit of catch up with the sell-off that occurred in the U.S. yesterday. This morning, so you are seeing that fall. You're seeing Stock 600 fall about 1% so far. That's being led by tech. There were some weak chip earnings that's impacting that this morning. But it is a rebound when it comes to NASDAQ futures, considering the fact, as I said, both Alphabet and Microsoft earnings came in stronger, helping lift those. The two-year yield, that slide continues, down nearly 5 basis points after a 13 basis point tumble yesterday, fueled by concerns around First Republic Bank. We're going to talk to our reporter Valerie Teitel about that in just a moment. But as always, it's a global bond market. Some bids when it comes to the front end of the German curve. Two years there, down 14.5 basis points. So as I said, Europe in worse shape than the U.S. futures picture. Most of the, if not all these regions, are lower this morning. You have, for example, the CAC 40 underperforming. Some concern there about Kering results as well as Dassault Systemes. So some of those big French companies weighing down on the overall index. Now, I mentioned First Republic. This is really the thing that moved markets yesterday and again continues to have ramifications today. It's said to be considering the sale of $50 to $100 billion of assets. It's all part of a turnaround planned. Now, those shares plunged as much as 50% yesterday, with the full extent of the challenges facing the bank dawning on investors. Let's get to Bloomberg's Valerie Teitel on this. Valerie, how close are we at this moment to First Republic going into receivership?
Look, the stock year to date is down 94%. They have been unable to stop these deposit outflows. The picture is not improving for First Republic like it is for some of the other regional lenders. Now, their asset sales that they're considering, 50 to 100 billion of asset sales. Now, if you look at their total loan portfolio, it's 170 billion. So this is a sizable chunk they are looking to divest. Most of these loans are long-term mortgages, which are underwater, but they're hoping to offload them above market value by offering sweeteners to these potential buyers in terms of preferred equity or warrants. Very similar thing that was done in 2008 in order to give some upside to these potential buyers if, in fact, First Republic's balance sheet does look better after the divestiture of these loans. But the problem is First Republic is not the only one looking to divest their balance sheet at the moment. Other regional lenders are doing the same, and the FDIC still sits on billions, which it's also looking to divest. Danny, there are not many buyers out there who can buy loan books of this size. And the big worry is this all ends up on the FDI's balance sheet as a liability to the U.S. taxpayer. And
we've seen that worry also filter through to markets, to Fed pricing.
Yeah, exactly. The most notable of what happened to the U.S. front end yesterday, we're now pricing in 80% of a chance of a Fed hike in May. That's just next Wednesday. And then also, if you look at how many cuts are priced in out to June next year, it's now at 170 basis points. That's more cuts than we ever priced in during the March banking turmoil. The conclusion is for many out there in the markets is that this puts a hawkish Fed next week, almost out of the question. And a big worry that the banking turmoil is going to turn into a long slog.
Yeah, maybe unfortunate for the Fed to be in a blackout period this week when this is all happening. Valerie, thank you so much. It's our reporter, Valerie Teitel. Now, it's also been a big week for tech and a great start to the earnings for them. Both Microsoft and Alphabet reporting earnings that beat expectations, moving higher in the pre-market. Microsoft really taking up nearly 8%. Let's get over to Matt Bloxham from Bloomberg Intelligence on this. Matt, I mean, you see it there. Both of them outperforming on earnings, but a huge move in Microsoft shares pre-market. What's behind that?
Yeah, I think it's improved optimism about the top and bottom line momentum this year. They delivered something like 10% constant currency growth on sales in the quarter they just reported, and are guiding to about 9% growth the next quarter. So I think cloud demand is holding up better than they expected. And I think they also gave a really good pitch about their push into AI, obviously with ChatGPT, and kind of really, kind of pushing home that commitment to kind of build that platform and try to take some of that huge online search advertising share that Google dominates. So I think that they did a good job of convincing investors that they've got great momentum in the business. And I think AI will also help their Azure cloud business, because as more enterprise customers use AI in their businesses, they're going to need more compute power, which is going to drive cloud demand.
Well, on the flip side, it did seem like Alphabet was trying to brush off that competition. Should they be so blasé about it? Should they be confident that they can keep market share?
Yeah, I mean, I think they're clearly very cognizant of the risk, and they're putting huge amounts of investment into their own AI product development, and they reorganize some of their own units to kind of help improve their investment and focus on that. So I think it is a big concern. They clearly have an incredibly strong position in that market, and consumer behavior is pretty much ingrained in defaulting to Google for search. So I think that there are barriers for people like Microsoft to kind of get over, which are not insignificant. But these tech markets can move very quickly, and if they don't keep up with what we're seeing from ChatGPT, then there definitely is a kind of a mid to long term risk. So they're cognizant of that, they're responding to it, they're cutting costs so they can invest more without it squeezing few quarters to see how this all plays out.
Okay, Matt, thank you very much. That's Matt Bloxham from Bloomberg Intelligence. All right, so we have a lot in terms of market news and moves to dig through. Joining us now to do just that is Bloomberg's Dana Al-Baltaji. All right, so we got tech, we got First Republic. I do want to start there just because of the huge reaction we saw in markets yesterday to it. What does this mean? The fact that we might have another failure of a regional bank, what does it mean for the Fed at this point?
It basically means that this priced-in hawkish hike that people assumed was going to happen might not actually happen. And I'm not saying that it won't happen, but it just puts that uncertainty out there. Because at this point, I think people are starting to realize that the banking crisis that we had in March is not over. There is a crisis of valuation out there, and it didn't end with just SVB and Credit Suisse. It's everywhere. So there is a funding crisis. We're seeing that in primary markets. And I think markets as a whole are worried about that right now.
Well, you can see in just the sensitivity of bond yield reactions. But I got to think probably the worst setup for hedge funds going into this. I mean, we just learned that they had record shorts on CFTC futures for the 10-year yield. Is it possible to dissect how much of this move is about positioning, is about short covering?
I think we will find out in due time whether or not that is the case. But at this point, there is a very real sense that people want safe assets. People just want to know that their money is safe and that, they're in big companies, big government debt. They don't want to take risks. And that's completely understandable with the fact that First Republic said what it said. There could be many other banks out there that are in the same position, and that's what people are worried about.
Now, I guess you could also say one of the ways to be safe is in tech. We certainly saw that during the initial turmoil, that tech outperformed. It came back a little bit, but I wonder if earnings from Microsoft, from Alphabet reinforce, hey, maybe tech still is a safety trade to some degree. Is there any validity to that?
Look, I think it was a really nice surprise what we got yesterday, but we still have Meta and we still have Amazon this week. So we need to see what happens there. But there is big tech and then there's tech. So they are two completely separate things. You've got big tech, which doesn't necessarily rely on the sort of funding that you would get from banks like SVB. And then you've got the smaller tech, which does need that kind of funding. So for that reason, it's not quite the same story. But these are some of the biggest corporations in the world, and they do move markets. So for that reason, there is some positivity there that they do have some good earnings, but we need to see what the other two companies say first.
Yeah, a really important distinction. Dana, thank you so much for joining us this morning. That's Dana Al-Baltaji, Bloomberg Managing Editor for Credit in EMEA. Now, coming up, Standard Chartered beats estimates with higher rates boosting profit. We're going to bring you our interview with CFO Andy Halford next. This is Bloomberg. Standard Chartered shares have dipped despite the lender reporting its largest quarterly profit since 2014. I spoke to CFO Andy Halford, who said the bank remained, quote, very, very stable during the recent turmoil in the sector.
Top line growth has been really strong for us. So we're up 13% on our top line growth. We were up double digits last year. So the overall performance of the business has been fantastic. The profitability is now up at the levels we last saw back in 2015. So a long period of time since. Interest rates going up has clearly been a help in that. But also we have seen a lot of client demand as particularly the Asian markets now pull through the COVID period and start to look forwards.
Does that mean that even if the Fed, the BOE, stops hiking, that interest income margins will have peaked, or is this not the peak yet?
So last year, our interest margin was about 1.4%. We have said this year we think it will be about 1.7%. And we have said next year we think it will be about 1.75%. So we are sort of nearing a higher level, but still on the rise.
So if everything looks good, profitability is still strong, your figure of $5 billion worth of capital returns by 2024, would you say that's a conservative figure then?
Well, we need to start somewhere. So $5 billion, we are roughly halfway through excuse me, in terms of what we have announced so far. $5 billion coincidentally will be the amount that back in 2015 we raised as a rights issue. So essentially it will be handing that money back. But I'd say overall we're well on track for delivering the $5 billion.
Are you still fearful that the worst of the contagion, again, emanating from a market far away from yours, but are you fearful that perhaps that's not over yet?
There obviously have been two major issues in the sector. But actually, for us as a business, we have actually seen our numbers stay incredibly solid. So our deposits have remained very, very stable throughout the period. So not that anybody is totally insulated from something going on in the sector, but I do think the fact our businesses are more based in other parts of the world. We are very spread. Our deposits are spread across many countries, many different types of client. I think actually our business model is a very robust business model for this sort of circumstance.
Well, almost, I mean, perversely, does it help you? And I'm thinking here specifically of Credit Suisse. Did you see flow that was clearly from them, clearly from their clients, especially in wealth management, fleeing Credit Suisse and coming into Standard Chartered?
I think if you look back over the last probably 6 months or so, particularly last year, we saw strong growth in our assets under management. I think some of that was probably helped by some shift away from some banks like that. So I think this will be a flight to safety. I think the bigger, more robust institutions that have been around a long time, are trusted, will be the beneficiaries of this.
In January 1st, Abu Dhabi Bank said it had explored a deal with Standard Chartered to buy it. Since February, it said it's no longer planning to do so. Have you had any conversations with them since? Is Standard Chartered, is the future still an independent bank?
We have had no discussion with them whatsoever. We are an independent bank. We are motoring well under our own devices. We're very pleased with our performance.
Independent from here on out. Andy Halford, Standard Chartered CFO there, on the confidence he has on their numbers, again, despite the recent banking turmoil. Now let's get over to the first word news. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. Renewed fighting in Khartoum is testing a fourth attempt at a nationwide ceasefire in Sudan. Smoke was seen rising from the presidential palace in the country's capital yesterday, with violence also reported in nearby cities. The UK, meanwhile, has begun evacuation of British nationals amid mounting criticism. It's been slow to react to the unfolding conflict. Now, Ed Sheeran has told jurors he would be, quote, quite an idiot to perform two songs together if copyright copyright infringement claims against him were true. The singer's been taking the stand in a New York trial, accused of lifting melody, chord progression and harmonies from a 1970s Marvin Gaye song. Sharon denies all the charges. US House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking an increase in the debt ceiling with spending cuts. In a rare sign of how close the vote could be, the outcome may not be known until the roll call happens. Both moderates and conservatives in McCarthy's Republican Party have expressed doubt about the plans. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. Now, coming up on the program, we're going to take a look at the man leading the French tech company Dassault Systemes. They, of course, reported earnings today. All of that next. This is Bloomberg.
Carlos is the Deputy CEO today. He has been working with me for almost 20 years. He has been the CFO, he has been in charge of all brands. So he's ready. I told him, which is probably unique in many companies, I told him that he should tell me whenever he's ready, and I think this should happen soon. So I will then become the executive chairman, and he will take over. That's why I was mentioning to Anna here that probably is one of my last quarter communicating with Bloomberg, because he's going to take the lead.
Bernard Charles is there, CEO of French tech company Dassault Systemes. Of course, maybe how long will he continue to be CEO? Right. He also has recently risen in the ranks of Bloomberg's global billionaires list. Bloomberg's Caroline Conan looked at his journey from intern to the C-suite.
From intern to billionaire, in 40 years, Bernard Charles has climbed to the top of French software giant Dassault Systemes. Today, the chairman and CEO of the Dassault holding company's biggest business is a billionaire and one of France's highest paid executives. With a compensation package of about $36 million last year, he's not far behind some of Silicon Valley's highest paid bosses. Charles is the frontrunner to take the top spot at the Marcel Dassault family holding in the next couple of years, one of France's most influential conglomerates. Dassault's business goes back over a century. It has grown into an empire spanning aviation, media, real estate, software, vineyards, and an auction house. Investors might agree Charles's rewards are justified. Over the past 5 years, including dividends, Dassault Systems has been among the top 10 most profitable investments on the CAC 40. Perhaps little wonder he was named among the world's best CEOs by the Harvard Business Review in 2017.
Bloomberg's Caroline Conan there. Now, from the Medicis to the Morgans to the Charles, I guess. Now, the business of lending, trading, and investing money has long been a path to astonishing riches. In a special on the Bloomberg terminal and website today, the team took a look at the risk takers and the innovators at the cutting edge of mainstream finance and those who have become the wealthiest from doing so. Joining us now, one of Bloomberg's own risk takers and innovators, Charlie Wells. I'm going to be honest, I didn't write that introduction, but I agree with it, Charlie. I absolutely
I take risks, calculated risks.
Okay, so maybe you haven't made the top of the billionaires list yet from those calculated risks. Maybe that's your problem. They need to be less calculated. But anyway, for those that did top the list, who were they?
I've got the list right here. And look, Ken Griffin coming in at number 1, wealth, $35 billion, definitely beating me there. Age, 54. Jeff Yass, founder of Susquehanna, one of the world's most successful proprietary trading firms. Wealth there, $33.1 billion, age 67. And then number 3 on our list is Changpeng Zhao, otherwise known as CZ, CEO of Binance. Wealth there, $28.2 billion, age 46. So blowing by me by far.
Well, they're also older than you, so you have time to catch up. Okay, so this is the new finance rich list, right? What makes them new finance? What was the category to decipher who makes the cut?
That's a really good question. So if you type rich go on the terminal, you will see the world's richest people. These are billionaires. So are the people on this list. But what we wanted to do is sort of figure out who had made money recently, people who hadn't necessarily inherited their wealth. So we excluded people who had inherited wealth. We excluded people who had been on that rich list 10 years ago, so from 2013. We excluded people who were, say, 70 and above, or people who had retired from their businesses. And what we got was this sort of younger group of people who have made their money quickly in the past 10 years.
What does that tell us about wealth creation then?
You know, Danny, what I would say is it's all in the computer. So I don't want to sound like Derek Zoolander, but a lot of the people who have made the top of this list really made that money by being powered by computer-driven trading companies. So you think about Ken Griffin, he's got a hedge fund, but he also has Citadel Securities. That is a global market-making business. It's one of the largest in the US. You think about Jeff Yass, number 2, again, really making sort of fast decisions there. And contrast this with some of the other people who are sort of at the top of the more traditional billionaires list, people like, you know, Warren Buffett. They make long-term bets as opposed to these people who are making bets and getting rewarded in splits of a second.
Really interesting. Charlie, thank you so much for breaking that down for us. Charlie Wells from the Bloomberg team. Again, you can check that out both on your terminal, not turmoil, and on the web. Now, coming up, we're going to be speaking to Zeno Staub, the CEO of wealth and asset manager Vontobel. We're going to get his views on the recent banking turmoil and the report last week. This is Bloomberg. Wall Street slides as turmoil at First Republic rekindles fear of a U.S. banking crisis. But U.S. futures rebound after beats at Microsoft and Alphabet reassure investors that this year's tech rally has room to run. The company outlines their vision for AI. Plus, Standard Chartered reports its largest quarterly profit in 9 years as rising interest rates boost its bottom line. We'll hear more from our interview with the CFO. Good morning. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London, in for Francine today. Now, First Republic's disappointing earnings and potential asset sales have rekindled worries that the banking crisis is not yet over. Now, at first, the lender's earnings spooked markets. U.S. stocks dropped. And then yesterday, there was further concerns about asset disposals. We also saw Treasury yields retreating. Clearly, those fears of banking turmoil and the potential contagion effects have captured the attention of investors yet again. Well, joining us now is Zeno Staub, chief executive of Vontobel, who himself has to deal with some market turmoil and fallout from this. Zeno, just on that point, how concerning would it be? Again, your world is far away from regional banks in the U.S., but how concerning would it be for the financial sector as a whole if we did have another regional bank go into receivership?
First of all, we're a global investment firm, so we're only affected in protecting the wealth of our clients in navigating this crisis. Second point, I think regulators and governments have shown very, very clearly that they are very, very determined to stabilize the global financial system. And therefore, I think it's an isolated regional issue in the US linked to basic mistakes in handling balance sheets, a repetition of the savings and loan crisis and the Office of Thrift Supervision failures from the 80s and the 90s, and that will be handled within the US government and regulatory system. We have no doubt about that.
Are you bracing for more regulation? I know Janet Yellen has talked about this idea that the non-banking financial institutions also need a closer eye, a closer looking at.
Well, first of all, I would start with applying liquidity coverage ratios and interest rate risk regulation to all banks and not only to the top 4 global banks, which is actually something that has happened in Europe. And I think all the numbers that came in from the European banks this morning, to which I was highlighted by our team from 24 here in London, were actually robust and solid. And I think the American system has to review the decision that all the regional banks were exempt.
So there might be some overlap in perhaps the type of clients that First Republic has and yourself, you know, high net worth individuals. They also had a big wealth management business. Have you looked at if they're disposing some of that potentially? Would you be interested in making any purchases there, if so?
We're not interested in onshore wealth management acquisition in the US, as we think it's too highly tilted towards an advisory approach. We're a global investment firm with a strong focus of long-term diversified assets. We're in fact the largest Swiss-based SEC-registered investment advisor, and we're going to stick to that strategy.
Well, and you certainly did have an increase in AUM in the results which you reported not that long ago. How much of those, if you're able to tell, came from Credit Suisse directly?
Well, first of all, our strategy is based on our strengths and not on the weakness of our peers. Second, if we would carve out the Credit Suisse flows, we would still have beaten our 4 to 6% target. But yes, clients trust us. Clients see that we're safe, stable, long-term, family-controlled. We see inflows.
Was it mostly Swiss clients then that shift came from?
We're very happy that we keep growing across all our focus markets, but it's perhaps important to see that our focus markets are predominantly developed Western-allied markets.
So part of the issue, though, not necessarily just inflows from other turmoil, but market turmoil in general tends to not be great for holding on to wealth management clients. Has that gotten better so far in April? Has some of that turmoil subsided and maybe made clients and wealth management assets more comfortable, I suppose?
No and yes. So the uncertainty is still here. It's also very important to see that January and February were completely different to March. January and February, people anchored expectations on inflation and on exit rates of central banks, so they were willing to deploy capital. March and April so far is dominated by uncertainty, which brings people to trust us with their overall assets. But in dialogue with them, we refrain from allocating or deploying all of them to on-risk assets.
To that point, are you at a point, because I hear it with market guests, market strategists, CIOs I speak to all the time, that everybody wants to be defensive. Is that what you're hearing from clients? Are they saying, get me out of risk completely, just put me in government bonds, put me in things that I'm safe in? What does appetite look like at this moment?
We see that clients have been very robust, very resilient. There is a reluctance now on the fixed income side to actually deploy. Again, very different. January, February, we saw strong inflows, strong signals of clients to deploy capital. Now, again, they want to see more visibility on inflation, which we think actually has peaked, and central bank policies. And then, so I think that the wall of money that will be deployed is there. It got just pushed out for 2 to 3 months.
If inflation has peaked, are you concerned about an ECB that, for the most part, has kept up its hawkish language, kept up its desire to continue hiking?
Central banks always run the risk of being too lavish too long and then perhaps also err on the other side. Let's see.
Let's see. So how have you been advising your clients to prepare in the meantime if potentially the ECB makes a mistake and takes it too far?
I mean, we obviously keep clients in short duration products, which is a very strong interest right now. So keep part of the powder dry, be careful on the duration side, but look at the value that is included in some of the spreads in fixed income markets, which we find quite astonishing. But again, clients need more visibility.
How have clients, behaviors, what they've said to you, how has it changed in a post-Credit Suisse UBS combinated world? How have their attitudes changed towards the financial, towards the asset management sector?
I would say not to a very large degree. I think we should not overplay that event. First of all, Switzerland has delivered on its responsibility to create stability in a very fast-track decision process over a weekend. Now, obviously, we understand and see that the different stakeholders will continue to criticize and to challenge part of the characteristics of that solutions. And also for Sergio and his team to sort this out, it will take years. But overall, this is not a a watershed moment for the general behavior of clients towards the financial center.
There had been some concerns that it just makes a Swiss banking behemoth that's just too big, that there's not enough market competition. Are those criticisms fair?
I think you have to look at it in a very differentiated way. First of all, the political process in Switzerland is not yet finished, so there will be Swiss bodies who will look into that situation. I think on the global wealth management side, there is a plethora of options and obviously also very strong additional brands. I'm not going to mention all my most admired peers, but we are obviously also one of the alternatives that is there. Swiss retail banking is very competitive. I think there are certain segments that people will look into it. Switzerland has also a history of being very open, so the country has always been more open to global competition than some of our neighbors are to us moving into their markets. So I would say companies and clients in Switzerland will continue to have a choice, but it's in certain areas a topic that needs to be watched.
Okay, Zeno, well, thank you for helping us watch the topic. Thank you so much for coming in, joining us this morning. That's Zeno Staub, Vontobel CEO. Now, quickly, while we're on the subject of banking of First Republic, let me take you into what those shares are doing pre-market. It is a big move to the upside, but recall First Republic fell some 50% yesterday, so perhaps not completely surprising to see some nibbles around the edges on that. Now, PacWest, another regional bank, that's having an even larger gain this morning, up 20%. It had fallen 9% yesterday, so same thing, moving in the opposite direction. PacWest did say this morning that deposits are now stable after turmoil had really slammed those shares, so some positive news from that front. At least that's what they're saying. So those shares moving higher in the pre-market trade. All right, coming up, we're going to check your other stocks on the move this morning in Europe specifically, including Kering, down this morning as Gucci's sales stutter. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Standard Chartered has reported its largest quarterly profit in 9 years. Rising rates help boost the London-based lender's bottom line with pre-tax profits of just $1.7 billion. I'm joined now by Bloomberg Markets Managing Editor Christine Aquino to go through all the most important stories in the UK this morning. So, Christine, starting with Standard Chartered, the results were good. Maybe a tepid reaction from shares this morning, though?
Yeah, exactly, Danny. Tepid reaction from shares. I think last I looked, they were actually treading lower now. And that really just goes to show that the banking sector sentiment at the moment is not great still. You know, we saw the turmoil in March really taking a toll on investor sentiment, and that rippled across various banks, despite the fact that the actual banks that have collapsed are really quite confined to the U.S. And then, of course, we know Credit Suisse here in Europe. Not so much really a UK story, but still, they got sideswiped in that move. And so I think, you know, for banks, there's a high bar for them to kind of really impress investors and kind of reassure investors that everything is fine, especially because, you know, looking over in the U.S., we're still seeing issues with First Republic and the likes. And so even with the beat today, Standard Chartered just not doing enough to kind of really reassure investors that, you know, the worst is over. Not probably a story specifically related to Standard Chartered, but just more broadly a banking sector thing.
Yeah, and maybe there's those concerns too that, okay, your net interest income looks good with rates moving higher, but maybe if the BOE and the Fed are about to stop, that will have peaked. Speaking of the BOE, I got sent this story a lot yesterday, Christine, about comments Hugh Pill made. What were they? What has everyone up in an uproar?
I mean, it was essentially Hugh Pill saying that basically people in business in the UK just have to get used to the idea that they're worse off, or, you know, that they're poorer, shall we say, than they were previously. And, you know, I'm sure it struck a lot of nerves yesterday. I saw this making the rounds on Twitter and various social media as well. And it's very interesting because in the context of, you know, what we're seeing in inflation, a lot of that, of course, falls under the Bank of England's remit. And there's definitely a perception that the Bank of England has just simply not done enough to curb stubborn inflation. It's still in double digits. They keep getting shocked by just how persistent it is. And I think the other piece of this story as well is that it's not that inflation is being driven by, I mean, yes, part of it is the wages story, but it is primarily a good story. It's the price of milk, it's the price of eggs, it's the price of energy that's really driving that. And, you know, a lot of that is the Bank of England's responsibility to rein in.
Right, and it wouldn't be the first time that they've gotten some blowback. I mean, I think of Andrew Bailey saying don't ask for raises this year, those sorts of things. Now, finally, despite the fact that we have this cost of living crisis that continues on, another great story on the terminal today that there's more of an uptake in private health care in this country. What's going on there?
Well, Danny, I mean, it's no surprise, right, that we've seen the NHS really crumbling. They've been really struggling in the COVID era aftermath. And then, of course, it's been plagued by strikes as well. Doctors and nurses alike taking the streets and demanding higher pay, despite the fact that the Bank of England is discouraging them from doing that. But and all of that really just coming to a head in terms of the services that they're able to deliver. We have seen long wait times, patients really kind of struggling to see their doctors, even for some of the most basic checkups. And so I think in this sort of era, the boom has been seen in the private healthcare industry because, you know, paying a premium does get you better service. You get what you pay for, right? And I think also with the struggles that the NHS have been having, a lot of these private healthcare providers have started to capitalize and kind of position themselves as the alternative.
Okay, interesting. Christine, thank you very much for joining us. That's Bloomberg Markets Managing Editor Christine Aquino. Now let's get some of our top corporate stories. With the Bloomberg Business Flash is Leanne Gerrans. Leanne.
Hi, Danny. Gucci sales barely grew in the first quarter as Kering's biggest luxury brand struggled to win more shoppers. Revenue at Gucci rose 1% on a comparable basis, missing analyst estimates, while sales at the division, which includes Balenciaga and Alexander McQueen, dropped 9%. The results stand in contrast to the strong performance of rivals LVMH and Hermes. Now, Ed Sheeran has told jurors he would be, quote, quite an idiot to perform 2 songs together if the copyright infringement claims against him were actually true. The singer has been taking the stand in a New York trial accused of lifting melody, chord progression and harmonies from a 1970s Marvin Gaye song. Sheeran denies the allegations. Apple is reportedly working on an AI-powered health coaching service and new technology for tracking emotions. Sources say it's planning to use Apple Watch data to create tailored fitness programs and iPhone algorithms to determine a user's mood from their speech and the words they do type. The move is part of a push to make health features central to Apple's product offer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you so much. All right, let's get a check on your stocks on the move this morning. Joe Easton from the Bloomberg equity team has that for us. Joe, what you got?
Morning, Danny. So we got plenty of red on the screen today, as you'd imagine. So starting over in Amsterdam, we got ASM. This is the worst performer here in Europe today, down 8%. They make computers that make chips that go into smartphones and other personal devices as well. And they are seeing a slowdown in projects, companies cutting back on their capex spending, and that is hitting that stock. That's the worst drop in almost 3 years. Meanwhile, we've also got the Gucci owner Kering, which Leanne mentioned there. That down around 2% over in Paris. The company today warning that quite a few people in the US that they describe as aspirational buyers, they're cutting back due to the cost of living crisis, and that is countering a bit of the strength that they've seen in China as well, and really in stark contrast to LVMH that have, of course, been rallying in recent weeks. Meanwhile, in the UK, we've got GlaxoSmithKline, this one down 1.5%. Now, the headlines were pretty strong on the top line numbers from GSK. However, some of their specific drugs have missed expectations, specifically in immunotherapy and also asthma. So analysts out today saying that the sales could be weaker in those key drugs, and that's what's hitting that stock today. As I say, down 1.4% in London. Meanwhile, we've got Persimmon finally giving us a bit of green on the screen, up 5%. This is the UK home builder. They are seeing a bit of an uptick in their home sales finally. Sales were up around 0.8% according to the firm, and that was surprising. They were expecting to decline as well, and that report is actually lifting a whole load of peers, including Taylor Wimpey, Bellwoe and Crest Nicholson as well in London. The home builders getting a boost. That one, the best performer on the FTSE 100 today.
Okay, Joe, thank you for the roundup with the overall index down about 0.6%. Joe Easton there from our equities team. Coming up, is Elon Musk a visionary for the car industry or steering Tesla into trouble? We'll discuss the autos biz next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. There's a raging debate in the EV space about Tesla's prospects. Some see Elon Musk as a visionary for the auto industry, and others think he is steering Tesla into trouble. That's a subject of today's Big Take, NI Big Take Go on the terminal for that. Let's bring in the author behind it, Bloomberg's car czar, Craig Trudell, for the bull and bear case on the company. So Craig, you lay this all out really well in your piece. What are the fault lines here? What is the dividing line of people say, okay, I don't like what's happening with Tesla? Of course, a lot of headlines last week about cutting prices.
Yeah, I don't think, it's simple to sort of sum this up as, Musk doing this sort of on his own volition, right? Mm-hmm. You don't cut the price of your best-selling model by 29% in roughly 3 months from a position of strength, right? That being said, this is not a case of the sort of sky falling and Tesla falling apart. The Model Y might end up being the best-selling vehicle in the world this year, so it's a really complicated story. I think it is the case that Tesla's vehicles got really expensive in the midst of all of these supply chain issues, and these were, of course, industry-wide problems of everybody not being able to make as many cars as they would have liked and as they had demand for. I think what we've seen with Tesla is a whole lot of production capacity come online very quickly, right. And that coinciding with this normalization of the supply chain and leading to this really drastic change in price.
Craig, less than a minute here, but is this going to start a pricing war with competitors? Is that the net effect of this?
I think there will be some cases of say, electric pickups where, even if the Tesla Cybertruck does come on, arrive on time, it will probably be lower volume. Maybe we'll see less competition in, say, the F-150 Lightning. But even within Ford's own lineup, you've already seen the Mustang Mach-E, which competes more head-on with the Model Y. They've had to take pricing of that down. So I think it will be in some spots we'll see a lot more activity and a lot more competition. In other spots where Tesla isn't playing, maybe less pressure.
Okay, yeah, I mean, we certainly saw impact on shares last week. Craig Trudell there after a very busy week for him in the autos industry. All right, that's it for Bloomberg Surveillance Early Edition. Tech continues to outperform after strong earnings. More earnings from Meta and others on deck. This is Bloomberg.
Microsoft's magnificently positioned. So is Google. So is Amazon.
I think tech outperforming, that could be forward expectations and forward easing expectations coming through.
The resiliency you've seen in earnings out of the index, so to speak, is because these businesses have magnificent income statement flexibility.
As a result, we're seeing our model sort of shift more towards technology.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Big tech surprises. Shares of Alphabet and Microsoft are higher after quarterly results are better than expected. Regional banks hope to rebound. First Republic may sell up to $100 billion in assets, while PacWest says deposits are now stable. And electric vehicle sales are expected to soar again this year after a record-breaking 2022. We'll discuss the global EV outlook with the executive director of the International Energy Agency, Fatih Birol. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller over in New York. And Matt, we seem to be caught between two themes on either side of the Atlantic. Europe still reflecting the nervousness around banks and perhaps a little bit of domestically generated nervousness on earnings here today in this time zone. But in terms of the US picture, you're looking ahead, looking at futures that reflect positivity on tech.
Yeah, I mean, earnings look pretty good from our perspective, unless you're looking at the banks, right? We saw First Republic come out yesterday with earnings that and deposit flows that really disappointed investors, then a conference call that disappointed investors further, then the possibility of an asset sale plan was reported by Bloomberg that disappointed investors even further, and First Republic ended the day down 50% after it's already lost so much of its value. And we saw a number of stocks yesterday on the S&P and the cash trade absolutely decimated, and that broke us out of this tight range in which we've been trading. We haven't seen a move up or down more than 1% for all of April until yesterday. We were off 1.6% on the S&P. We now see futures, though, higher this morning, so maybe some investors think that move was overdone. Maybe there's positive expectations for earnings to come out today. Investors are also letting go of U.S. government debt. So the 10-year yield, although it had come down to a pretty low place, is now moving just slightly higher right now at a little over 340. The Bloomberg U.S. dollar index is lower, so that signals investors aren't worried enough to seek the safety of the greenback. That tends to be what they do, and you see the dollar losing ground against the euro, against the pound, against the yen. So wherever you look, a weaker dollar this morning, and against Bitcoin as well, I should point out. Up 2.8%. We had fallen down to 27 and change yesterday. Now we're back up to 28,767. So you didn't see the negative correlation with the cash trade. You see a positive correlation with futures today. Take a look at Asian markets. We see a little bit of a mixed trade there, at least in terms of what's going on in Hong Kong versus Tokyo. The broader MSCI Asia Pacific was little changed, but the Hang Seng in Hong Kong up 0.7%. The Nikkei closed down 0.7%, and they're mirror images of each other in terms of the percentage moves. I will just quickly mention that Nomura Holdings came out with profit that was that dropped by 3/4 in the quarter compared to the same quarter last year. They had a drop in fixed income trading due to the volatility that we saw at the end of the first quarter, but it's a pretty light move, only 1%. So it looks like there is banking nervousness around the globe, Anna. But the problems at First Republic are pretty endemic to First Republic and not, I think, showing signs of a wider crisis in the banking industry.
Yeah, and what is also interesting, Matt, about that is that, yes, Europe is down and the bank sector is down, reflecting weakness on Wall Street yesterday. But the bank sector isn't down particularly more than any other. So it isn't really a focus on banks here in Europe. It is maybe that negative sentiment coming from the United States, but not concern about banks specifically in Europe. And certainly we saw last time around, back in March, we remember well the way that that nervousness transmitted across the Atlantic. So this time looks a little bit different, perhaps. We are seeing, though, some more European-generated nervousness around specific earnings reports. They certainly haven't all been rosy this morning, but there have been some bright spots. Generally, though, we are weaker, down by around 0.5% on the CAC 40 and the Xetra DAX in Paris and in Frankfurt. Let's have a look at some of the movers then, some of the individual names that are in focus today. I know we've got to focus on GSK. This is the UK-based, of course, pharmaceutical giant. The stock is down by 1.3%. The numbers didn't look so bad, but maybe there was some conservative estimates in there. That's certainly one of the reactions from analysts. Kering, the luxury goods company, one of them, based over in European-based, of course, and this business is down by more than 2%. The expectations were so high, given what we'd heard from others in the sector, the likes of LVMH and Hermes. We didn't hear the same from Gucci, which is owned by Kering, and so as a result, the stock sells off. And just thinking about where we're not seeing negativity, and it isn't everywhere, we heard from the CEO of Telia, which is a telecoms business in Scandinavia. They're saying they're not seeing any signs of recession in any of the markets that they operate in, which I thought in itself was interesting. That stock up by 5.6%. And this is the other side of, Matt, what you were talking about with the weakness in the dollar. So even if we're weaker on stocks, there does seem to be room for risk appetite because we see weakness in the dollar and we see, yes, the market buying euros, buying the pound. Here's the euro move back over 110.
All right, interesting stuff. Dollar weakness definitely across all of its trading partners, major trading partners today. Let's get back, though, to the big tech earnings and kind of the war in AI. Microsoft third quarter profit and sales came in better than expected, boosted by resilient cloud computing demand. And Alphabet's results also beat estimates as its cloud unit turned a profit for the first time. On the earnings call, Alphabet's CEO spoke about the strength in that company's Google search business.
The fundamental drivers here are people are looking for relevant information, and in commercial categories, they find ads to be highly relevant and valuable. All those dynamics, I think, which have long served us well, remain, and as I said, we'll be iterating and testing as we go, and I feel comfortable we'll be able to drive innovation here like we've always done.
Joining us now for more is Bloomberg Intelligence analyst Matt Bloxham. So I find this so interesting that Google and Microsoft are now competing on both search and cloud. Obviously, Microsoft had real strength in the cloud market. Google has dominance in the search market. But is that set to maybe change?
Potentially so, and I guess if there's going to be a big change, it's likely to be in the search advertising business, where Google dominates with 93% share of the global market versus Microsoft's 3% with Bing. It's such a huge market that just a small amount of share gain for Microsoft on the back of their AI investments could really add a lot to their revenue and profit. Clearly, Google has been in the cloud business for some time. It's growing some momentum now. They recorded a profit in that business for the first time ever, but they're a long way behind both Microsoft and Amazon on cloud. So there's still a lot of work for them to do there to be considered to be a real big player in cloud for enterprise.
Yeah, Matt, good morning. What else did you take away from this set of earnings? We've got confirmation, perhaps, that Google still is the search giant that we've known it as, and there has been this big focus on AI.
Yeah, I think, for a lot of people, it was this resilience in enterprise spending on cloud. My colleague Anna Agrana, kind of suggesting that maybe the worst is over in terms of the enterprise spending slump. We'll have to see if that plays out. But I think people will take optimism from both sets of results, and that's obviously a good read across into Amazon later this week. And I think, although there's resilience there in Google's ad business, I think we're getting more mixed messages from the broader ads ecosystem. And I think we're going to see a more mixed set of results from the likes of Meta and Snap later this week, because I think Google's search business is the default that brands use. They know it, they trust it, rely on it. The return on investment's really good, right. Perhaps less so for Meta or Snap.
Well, and for consumers, Matt, what's your experience? Have you used Microsoft's new AI-assisted Bing?
I've played around with it, and I've been waiting to get through the wait list on Google Bard, so I'll play with that one too. I think what they said, 100 million or so active daily users on that platform. And I think a lot of people are just experimenting with it. They're curious, wondering what it does. Whether it becomes what people use as their default to search for things is a much bigger question. Obviously, people are so used to using Google to search for things. I think it's going to take a lot for people's behaviors to change.
All right, very interesting stuff, Matt. Thanks so much for joining us this morning. Matt Bloxham there of Bloomberg Intelligence. Now let's get to the banking story. First Republic Bank is considering selling up to $100 billion in assets. This comes as the beleaguered lender attempts to rescue itself from the turmoil that engulfed the industry last month. Bloomberg's Valerie Teitel joins us now for more. So, Valerie, is this about stopping, the FDIC and other regulators from putting First Republic into receivership first?
Well, look, First Republic has really failed to prevent the deposit outflows from stopping, and it's causing a lot of problems for its balance sheet. It's definitely taken the eye of the FDIC, and now there's reporting that they're looking to offload up to $100 billion of their assets. Now, if you put that into context, their total assets near around $230 billion, but their loan book is $170. So it would be a sizable chunk of their loan book they're looking to offload. They hope to offload these above market value by offering potential sweeteners to buyers, such as warrants or preferred equity. That's a very similar strategy that was used in 2008, which helps strengthen First Republic's balance sheet and then offers a potential upside to those buyers. But the problem is now, Matt, that the First Republic is not the only bank out there looking to divest loans. Other regional banks are considering doing the same, and the FDIC is also divesting the loans they still sit on. And clearly there's just not that many out there who can buy loan books of this size. And the market worry is that ultimately, if a buyer isn't found, these loans will end up on the FDIC's balance sheet as a liability and at the end to the U.S. taxpayer.
Okay, an interesting, certainly a fascinating story, one that has continued to grip markets and reminded us of what we were worried about in March and how it hasn't all completely gone away. And given that, Valerie, did this then have an impact on Fed pricing, on thinking about how many more interest rate hikes we'll get from the Fed?
Look, the Fed meets next Wednesday, and I think this takes completely off the table that we get a hawkish hike from the Fed. The probability even for a hike for next week dropped to 80%. And then if you look at how many cuts are priced into the curve, we're pricing now more cuts out to June next year than we were at any time during the banking crisis back in March. So, the conclusion is that this could be a long slog of a banking crisis, and a hawkish Fed is something we're not likely to see next Wednesday.
All right, Valerie, thanks very much. Valerie Teitel there talking about the destruction of First Republic value and what they plan on doing about it. Amid the resurgent banking angst, rattled stock markets may have to live without a key source of buying power. That's the warning from Goldman Sachs' Scott Rubner. His data shows that quants are running out of ammo for buying stocks, and they're already pretty long. Bloomberg Markets reporter Justina Lee joins us now with the details. So, who are these quants that we're talking about? Which specific strategies, and why are they out of ammo when there's, so much cash on the sidelines, right?
Yeah, I mean, Goldman here is really focused on what we call commodity trading advisors, which are mostly trend followers, and volatility control funds. And if I can simplify entirely, I guess the basic way to think about what trend followers do is, if stocks are rising for a period of time, they're buying and vice versa. And for volatility control funds, they're basically buying assets where the volatility is falling. And that kind of explains why, as Goldman estimates, these groups have been buying $170 billion worth of stocks over the past month, which took their exposure to the highest since early 2022. And now, so that's already a pretty different picture from what fundamental managers might be doing. And what Goldman is saying here is that if stocks do keep rallying, this group doesn't really have a lot of ammo left to keep buying. But on the other hand, if stocks do start to reverse, then they have a lot of room to take down their exposure.
Okay, so does this suggest then that stocks would be weaker because quants, can't keep on buying forever? It seems to fly in the face of what we heard about the hedge fund community, which maybe have been putting shorts on stocks. We covered that story a little earlier on this week.
Yeah, right, exactly. Because a lot of fundamental analysts are seeing, issues in the economy. They're worried about credit crunch, recessionary risk, and of course, bank risk coming back again. So there was a school of thought that perhaps we have seen stock markets recover so well after Silicon Valley Bank collapse because quants have been doing this. Now, this is a slightly controversial view. Not everyone agrees with it, but I think the bottom line from Goldman's warning here is that if you believe that this group was the support for the market, I mean, that's going to rapidly dissipate.
All right, Justina, thanks very much. Really interesting stuff. Justina Lee there talking about the Goldman Sachs deal on systematic, on rules-based hedge funds that have bought and may sell. Let's talk about some of the pre-market movers. PacWest Bancorp is another one often mentioned in the same sentence as First Republic. It had a rough day yesterday, and we're seeing a bit of a bounce today, up 18% in the pre-market to 12.12. So watch PacWest. As I said, maybe First Republic's problems are solely those of First Republic and not issues across the industry. PacWest seems to have done a better job of stemming outflows. In terms of the earnings that we got yesterday from Microsoft and Google, we do see Microsoft shares moving up considerably in the pre-market. Remember, those earnings came after the bell, so you can watch Alphabet, you can watch Microsoft this morning. For its part, Satya Nadella's company is up 7.6% in the pre-market after saying that investors are really excited about the AI-powered version of Bing. Maybe the first time consumers have been excited about Bing in forever. NVIDIA is up today after some analysts raised the stock to a buy, and also the chip maker said that it's got new software that helps to keep AI chatbots on track. So it's only only a 2.2% gain, but it's in the vein of AI, so investors are going to be watching this, maybe trading it heavily today. And then a deal that I've been following for a couple days, a potential deal that the Target says isn't really a potential deal. Getty Images down another 5% to $6 in the pre-market. It says that Trillium Capital's $4 billion takeover bid is not sufficiently credible. Remember, Trillium had been saying Getty needs to sell itself for $12 a share. Then Trillium came in and made a hostile bid for $10 a share. But Getty Images, of course, is majority controlled by the Getty family, which doesn't want to sell anyway. So what are you going to do about it? As a result, other investors are left with shares that are worth less. Anna?
Okay, so those are lots of stocks to keep an eye on pre-market. Coming up on the programme, we'll talk to Madison Fowler, JP Morgan Private Bank Global Investment Strategist, get perspective on the markets. We'll also have a conversation about the growth of electric vehicles and what this means for the other energy markets. The IEA Executive Director, Fatih Birol, on the global outlook for electric vehicles and much beyond. Plus, the new finance rich list. We'll take a look at some of the risk takers and innovators representing a new era of wealth. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards out in London. And I've got a chart that represents, in some ways, the credibility of the Federal Reserve, right? Jerome Powell continues to tell us that he and the Fed are not going to cut rates in 2023. In fact, not until they see inflation down much closer to the 2% level that they need to see it. And for a while, it looked like the market believed him. This is the probability of Fed rate cuts over the next 12 months. Now it looks like the market doesn't believe him anymore. They expect the Fed to cut rates by 170 basis points over the next 12 months. Joining us is Dana Al-Baltaji, Bloomberg managing editor for Credit, to tell us, Dana, what's your take on this chart on the Fed credibility, especially amid banking turmoil that seems to have, peeped up again?
I think it's important to note that the narrative has shifted over the last few weeks. We are starting to see economic data that is worrying and that is allowing people to even imagine a time when the Fed would cut. That's why that narrative is really taking hold. We're seeing job cuts. We're seeing earnings that aren't very encouraging, of course, excluding what happened yesterday. And so for that reason, the possibility of Fed cuts is becoming more and more a reality. I think at some point, investors are weighing whether or not the Fed and other central banks will continue to raise rates, even if inflation is high, when there is a recession out there.
Okay, good morning to you, Dana. So we're worrying about economic data. We're clearly worrying about the banking sector, getting a reminder on many fronts that we maybe stopped worrying about the banking sector a little too early. But then on the other side, we're getting these numbers from big tech, which are pleasing in some sense to the markets. And certainly NASDAQ futures up 1.3%, reversing some of yesterday's nervousness. What does that tell us?
So look, big tech, I think we are talking about some of the biggest companies on the planet. These guys, they have a completely different measurements. Their advertising revenue and the way that they make money isn't the same as the way other companies make money. These guys have a completely different model, but also they don't have a funding squeeze. Other companies are facing problems when it comes to funding. And for that reason, yes, you can be completely positive about the earnings that we saw yesterday, but that doesn't necessarily mean that the economy and other companies are okay. We are seeing in the primary space that the cost of money is super high, and a lot of companies can't afford it.
Okay, Dana, thank you very much. Dana Al-Baltaji joining us there from here at Bloomberg, of course, bringing us the angle, I suppose, the slant from the credit markets as well, adding that in. For more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. For the Markets Live blog, this is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking a debt ceiling increase to spending cuts. Still, The measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in a case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in the space. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Big tech surprises. Shares of Alphabet and Microsoft are higher after quarterly results are better than expected. Regional banks hope to rebound. First Republic may sell up to $100 billion in assets, while PacWest says deposits are now stable. And electric vehicle sales are expected to soar again this year after a record-breaking 2022. We'll discuss the global EV outlook with the Executive Director of the International Energy Agency, Fatih Birol. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it'll be interesting to see through the US session whether this positivity around tech continues to outweigh the nervousness that we saw so dominate the thinking yesterday, which was around the banks.
Yeah, I mean, it's exciting again, right? We have real movement in markets yesterday to the downside. Today we see futures moving to the upside, not obviously outweighing the drop that we saw in the S&P 500, but there's so much going on in tech, in banking, in politics, in culture, dare I say. S&P futures are right now about 0.4% as investors are optimistic about earnings that we're expecting to come out today. And, of course, what happened after the bell yesterday with the big tech heavyweights, Microsoft and Google, both beating earnings expectations. The U.S. 10-year yield is rising a little bit as investors let go of some of that paper. It's not a huge move. Right now we're at 340, but, you know, we've been over 350 some of this week, so that has come down substantially as I guess that's a kind of a tailwind to stocks because it's less competition for what you could get yielding from those shares. And the Bloomberg Dollar Index is also down. That's also good for stocks. It means investors aren't running for fear into the greenback globally, and that a lot of assets are worth more in dollar-denominated terms. Bitcoin, for example, is one of those assets. Right now, $28,817. So getting closer and closer back to the $30,000 level as the Bloomberg Dollar Index falls against everything else. The euro, it's down against the pound. It's down against the yen. In terms of market movers, there are a lot of them today. PacWest is one that has a big bounce to the upside on investor bets that the problems at First Republic are only problems with First Republic and not with the rest of the banking industry. The deposit outflows that you see at FRC are not the kind that you see at PacWest. Microsoft beat expectations and has investors really excited about the AI-powered version of its Bing search engine. Google obviously dominates in search with 90% of market share, and the last figures I saw for Bing were like 6.7%, but that could change. On the other hand, Google did really well in cloud, which is where Microsoft kind of dominates. NVIDIA also being driven by the AI trade today. It says it has software that allows the AI chatbots or keeps AI chatbots on the rails. I think my boss wishes we had software like that for me. And then you see Getty Images right now down 5% to $6 even. Getty Images is like 80% owned by the Getty family and friends. So they decide what happens with this company. However, Trillium, which also owns a stake, has said it wants to buy Getty Images for $10 a share. It had previously urged Getty to sell for about $12 a share, but there's really nothing you can do if you don't control the 80% majority. So as a result, those shares have continued to fall and now are down more in the pre-market. Anna?
Well, let me tell you what's going on here in Europe then, and keep things on the rails, Matt. We've got stocks here in Europe down by 0.7%. And really, it is a little bit of the sentiment of yesterday on Wall Street, but some of it's homegrown in Europe as well. Whereas technology futures in the US are going higher, tech is an area of weakness today for Europe because of the reporting season here. It's a very different kind of tech, obviously. And we don't see all the negativity centered on the banking sector today, as we might have done in previous periods of concern around banking globally. So that's where we are overall. GlaxoSmithKline down by 1.2%. The numbers themselves not that bad. Some analysts, though, suggesting there had been a higher expectation on guidance, so maybe that was a little disappointing for some. And Kering, the luxury goods business, owner of Gucci, of course, the stock down 2.3%. A victim of the competition, a victim of the expectations following the results from the competition. We heard from LVMH, heard from Hermes. Both of those made it look easy to make big money in these markets, and Kering, as a result, the stock moves a little lower on its numbers. The euro is up by 0.7% this morning, Matt, and this was really the other side of the trade you mentioned earlier. We are seeing dollar weakness in keeping with that rally that we're seeing in stocks stateside, and the fact that we saw a lot of haven seeking yesterday, so a lot of money going into the dollar yesterday, some of it coming out today, and so the euro benefits the pound and a host of other currencies as well.
All right, very interesting FX trade there. Let's get over to Madison Fowler right now, JP Morgan Private Bank Global Investment Strategist. And Madison, just quickly on the banks, right? We've seen turmoil that freaked us out in March and then kind of subsided. April, there was almost no way to break out of, it seemed, this tight trading range they were in. Now, First Republic has kind of blown that out of the water, but is it just an FRC issue and not a broader banking issue?
Sure. Thank you so much for having me. And I think what we're seeing there is just some continued jitters around what are the ripple effects of this concern around banking confidence really going to look like. But I do think it's important to separate some of the banks that have been struggling and then also the banking sector as a whole. And so I think on that latter point, what we've really been seeing is that from a broad bank perspective across both regional banks at large and also larger money center banks, bank earnings have actually been quite solid. Deposit flows have steadied quite a bit. And we've also seen bank borrowing from the Fed also start to ease as well. And so from my perspective, I don't think that this is really a crisis of confidence, but I do think it's likely that we continue to see some jitters, especially around some of these names.
Yeah, Madison, good morning. It'll be really interesting to see how frequently we go back to being worried about the banking sector in amidst all the other news flow. And some of that other news flow takes us higher today in terms of risk sentiment. So, NASDAQ futures up by 1.2% because of the strong earnings story out of tech names. I mean, tech had such a tough 2022. It's already had a good year to date. What is left, do you think? What comes next for the tech space?
Sure. So I think when we first think about the performance that we've seen so far, again, as you mentioned, we had a really tough 2022. And then in addition to that, I think a lot of what surprised us this year is just those aggressive cost-cutting pressures that have really, I think, gone to ease margins. And in addition to that, you are seeing some strong earnings come out of that as well. I think moving forward, and what we especially saw during that episode of bank confidence being challenged, is that people really thought of tech as kind of a safe haven in the port, and they really resonated with these higher quality names that have more stable and consistent cash flows. And so I think when growth starts to become even more scarce as we experience what higher interest rates ultimately mean in the economy, that I think rally for mega cap tech can probably go a little bit further. But I do think as the interest rate environment grows more challenged, as economic growth starts to slow, that it's possible that over the medium term, so think over the next 3 to 5 years, some more interesting opportunities in the mid to smaller cap space, I think.
Okay, that'll be something to watch. Yeah, Matt Bloxham was talking about enterprise spending, whether that's bottomed out or not. We will watch that. Where does that leave conversations around Europe versus the US? Because tech's had a good 2023. Europe was having a pretty good 2023, in particular luxury names, for example, especially when banks in the US were under pressure. Does Europe's outperformance, is that a theme for the year or is that gone?
Sure. So I think there's a little bit further to go with that. At some point, it might make sense to take profits, but I don't think that we're there just yet. When I think about relative economic growth, Europe looks to be in a much better place. We don't anticipate a recession in Europe this year, whereas we do for the U.S. Relative earnings expectations also look better for Europe. In addition, when you I think add in the valuation component as well, Europe is still trading at a 25% discount to the U.S., which is wider than that 20% average. And so I do think that there's still room to go there, and we're really looking into those areas like national champions of their industries. We're looking at semiconductors, oil and gas companies that again have those strong cash flows, and also segments of the luxury sector.
What is the data? What are the data points? What are the events that you're going to be watching closely, Madison? Obviously, we have some data coming out this week, and then the Fed meeting next week.
Sure. So I think we're getting a lot of inflation data over the course of the next few days, especially in the U.S. and also in Europe. And I think that's also really going to set up those Fed and those ECB meetings that we're also going to have next week. So for the Fed, we think that, given the fact that inflation is slowing but still elevated, the Fed probably hikes once more next week. But when it comes to the ECB, inflation's in a different place. It's still quite high. We saw core inflation hit a record the last print that we had. And so I think as we're watching, the prints that come out over the course of the next few days, the ECB is likely to be quite data dependent heading into this meeting. And the debate, I think, is quite, ripe around whether that's 25 or 50 basis points for the ECB next week.
Madison, thank you very much. Madison Fowler of JP Morgan Private Bank, thank you for joining us. Coming up on the program, we'll talk energy and the future of transportation. The IEA Executive Director, Fatih Birol, will be with us to talk about the outlook for global electric vehicles, what that means for energy markets. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the former Bridgewater CIO, Bob Elliott. That's at 2 p.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, almost 1 in 5 cars sold worldwide this year will be electric, either fully electric or a plug-in hybrid electric vehicle. That, according to a new report by the International Energy Agency. The shift to EV is set to have major implications for the energy industry and infrastructure. Joining us to discuss that is Fatih Birol, Executive Director at the IEA. Fatih, you put out a report, the IEA put out a report today that's absolutely fascinating in terms, I think, of the swiftness of the EV pickup globally. First of all, are you concerned that this is going to have a detrimental effect on the energy infrastructure? Can our grids really take this many electric vehicles trying to charge up?
Yes, you are right. The penetration is very fast and very big. In all 3 large car markets in the United States, in Europe, and in China. China is the leader, and in China, in Europe, we see that the charging stations infrastructure is built by day, and they are keeping up with the pace of electric car industry. Let me give you just 2 numbers to show you how big the penetration of electric cars is. 2019, only 4 years ago, 2% of all the cars sold in the world was electric car. So 2% in 2019. And this year, about 20%. Every 5th car would be an electric car sold in the world. And more impressive, I believe, 2030, which is tomorrow, in US, China, Europe, 3 largest car markets in the world, 60% of all the cars sold will be an electric car. 60%, three largest car markets. And this will have implications for the oil industry, for the electric grids, and beyond that.
I mean, it's massive growth in a percentage of new car sales. I think it's still a pretty small amount in terms of the total global vehicle fleet. But you mentioned, the implications this could have for the energy, makeup. What implications does this have for OPEC, for U.S. energy producers, for shale producers? I mean, everyone, you included, has been calling on energy oil producers to boost supply. Do they really need it if we're going to be all buying electric vehicles?
So oil is not only consumed by the cars. The road transportation makes about 40% of the total oil consumption. There is also a petrochemical industry. There is aviation. We need oil for that. But road transportation, namely cars, buses, and trucks, they have the lion's share. So when I look at the electric cars and what is happening in the buses and trucks, I can tell you that the oil demand dynamics of the oil industry will be a bit different than many stakeholders hope to see in the oil markets, because they'll be much lower, especially for gasoline and diesel. The demand will be much weaker. And if the oil producers try to push the prices up, oil prices, this will only accelerate the electric cars penetration.
Okay, and in that context, Fatih, good morning. I wanted to ask you about something more about the near term, a bit more short term in terms of where we are on prices. Around the time that OPEC Plus cut production, we saw a spike up in oil prices, but now that's come back down again, so a few weeks ago. Do you still think, though, that it was a mistake for OPEC Plus to cut production because of what you described there, that it will speed up the transition away from this type of energy?
I think they have to be very careful because higher energy prices mean, and which is what those countries wanted to see, a weaker global economy, especially weaker economy in the emerging countries, and B, it will give an additional boost to clean energy transition around the world, including electric cars. So their short-term interests vis-a-vis their medium-term interests is here in contradiction. They have to make up their mind well. Okay. But what I believe, the global economy is in a very fragile stage. To see higher oil prices and upward pressure on inflation is the last thing that we want to see.
Okay, and with a focus on production and supply to the markets then, Fatih, can I ask you about Sudan? The United Nations is warning of a spiralling crisis there. Aside from the obvious humanitarian concerns, are you also worried about whether supply from Sudan and also South Sudan, which relies on transit through its neighbour, whether we will continue to see all the supply that we're used to from Sudan?
We are following it very closely. For the time being, there is not a major risk. But if the tensions continue, we may see some disruptions there. So this will be another headache for the oil markets.
Fatih, thank you very much. Thank you for joining us. Really good to get the details of your report and to talk about where we are on markets. Fatih Birol, the IEA Executive Director, joining us there from Paris. Coming up on the programme, the new finance rich list. We'll dive into some of the risk takers and innovators representing a new era of wealth. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, a look at what's ahead today. At 8 a.m. Eastern Time, ECB Vice President Luis de Guindos is scheduled to speak at the Delphi Economic Forum in Greece. That's followed by data on U.S. wholesale inventories, or inventories for you, Anna, and durable goods at 8:30 a.m. Before the U.S. market open, we'll get earnings from Boeing, and then after the bell, Meta reports, that is, of course, Facebook. The company is forecast to return to growth after 4 quarters of decline. So we continue to have a very exciting docket for today, and I'm looking forward to it.
Yes, I'm glad. I'm glad that you're looking forward to the continued focus on tech. NASDAQ futures up by 1.2%. Now, let's talk about, wealth, shall we? In the past few years, the fortunes of the wealthy have only become bigger. The largest share of the riches goes to the risk takers and innovators who are comfortable at the cutting edge of mainstream finance. Bloomberg's Charlie Wells joins us now for a look at a new finance rich list that Bloomberg has put together. So, Charlie, who made the top list then?
Yeah, Anna, so they're newer and they're more recent. And at the top is Ken Griffin, founder and chief executive of Citadel and Citadel Securities. We've got his wealth at $35 billion, age 54. Number 2 is Jeff Yass, founder of Susquehanna International. Wealth there, $33.1 billion, age 67. Rounding out at number 3 is Changpeng Zhao, CEO of Binance, the crypto exchange. His wealth, $28.2 billion, and age 46. So this is making my bank account seem very small.
What's the methodology here? Because there are no women, for example, on the list. So I'm wondering, how do we pick these new rich people? A lot of them are, old rich people.
Yeah, Matt, that's a really important question, and it is very unfortunate not to see women on this list. Hopefully they will be there in the future. But what we basically did was on the Bloomberg terminal, if you type Rich Go, you can see a list of the world's wealthiest people. But we wanted to figure out who had been making money over the past decade or so, who has entered that list. So we filtered out people who had been on the list before 2013. We filtered out people who had largely inherited their wealth, people who were over the age of 70 and who have retired. So what we got there was this list, topped by Ken Griffin, number 2, Jeff Yass.
Okay, and it's interesting, isn't it, the way that people are making money in different ways, I suppose, to be really sort of obvious about it. This isn't about it's not about being Buffett or Schwartzman maybe and long-term patient capital. It's not about that. I'm not sure if that's a good or a bad thing, but it's more about technology-driven traders and quants and that sort of area.
Fast money.
It's about the computers, yeah. So being able to leverage technology to make really quick decisions. So, there are some hedge funds on this list that do make some of those longer term bets. But what we really saw were people like Griffin, who, of course, is Citadel Securities, one of the largest market makers in the world, really being able to have that information and make calls really quickly and able to make money off of that.
Okay, Charlie, thank you very much. Charlie Wells joining us there with the latest on this new finance rich list. Matt, we didn't make it.
No, we didn't. I'm more of a buy and hold kind of person, Anna.
I'm not sure we were in contention.
I'm also older, I noticed, than a lot of people on the list. It starts to make me feel a little bit uncomfortable. I don't know what I've done wrong.
That is it for Early Edition. Surveillance is up ahead. They'll be hearing from David Rubenstein of the Carlyle Group. No doubt a fascinating conversation there. They'll continue to cover the tech earnings stories as well. Of course, we've heard from Microsoft. We heard from Alphabet. We'll hear from other big names within the tech sector, though, as we move through this week. They'll keep you across the bank stories as well, as we've continued to see the way that the banking sector, regional banks in particular, can suddenly push the markets around just a little bit, as we saw yesterday. This is Bloomberg.